Mark Matthews, Head of Research with the Bank of Julius Baer Asia, joins us with a quick global market check and what he makes of the current crisis in Ukraine. Mark, good to have you back. Thank you for joining us. Mark, how are you viewing emerging market equities at the current juncture, which have seen massive outflows as developed markets are gaining traction given the trouble in Ukraine? Would you think any emerging markets will stand to benefit directly or indirectly?
I can't think of anybody who benefits from Ukraine, but I would say that Russian equities have clearly collapsed, and if you add on the fall in the Russian ruble, if there is some kind of resolution there, clearly the upside is most obvious in the Russian equity market. It's not a market that we traditionally recommended because we don't like corporate governance there, and it tends to be very commodity heavy. We also don't particularly like commodities, but that would be the area naturally to look for a bounce when a solution occurs. As for emerging markets as a broad asset class, if you look back over the last 10-20 years, every year there are pockets of opposite performance to the broader asset class. So what I mean, for example, last year emerging markets as an asset class were down, but there were select emerging markets like Malaysia, like Taiwan, which were actually up quite nicely. So I think this year it'll be a mixed bag for emerging markets. Some will be up, some will be down. And we're already seeing that actually. We're already seeing that this year. Best performing markets in Asia are Indonesia and Vietnam, worst performing markets are China and Korea.
Right, Mark, hi, morning. US fourth quarter GDP has been revised down sharply from the earlier 3.2 to now 2.4%. What's your take on this revision, and would you expect a rebound in the next quarter?
My take is it's weather related because the largest culprit in the downward revision was vehicle sales, and the reason for the slower than expected vehicle sales was certainly the weather. And if you look at internet sales, they've actually been very robust, whereas other retail sales where you physically have to go to the store to buy something have been down. So I think it's the weather, and as a matter of fact, last night we got several data points from the United States that indicate better than expected economic performance. So I'm willing to give that economy the benefit of the doubt.
So Mark, how do you see the US Fed going ahead with the QE tapering?
I think that unless I'm wrong and the weather is not the reason for the softer data, we can expect increments of $10 billion in reductions of Federal Reserve purchases of securities at each of the FOMC meetings, and there's 7 more scheduled between now and the end of the year. And that means that by the end of the year, the quantitative easing program should be finished.
The dollar index, Mark, has been trading under pressure. How are you viewing the dollar trade going forward?
So I think there are two opposing forces. The first is, if you look at the dollar index, the largest weighting in it is the euro, and European banks have been steadily repatriating assets from overseas to recapitalize their balance sheets following the first global financial crisis and then subsequently this European crisis. So there's been this constant structural inflow of capital into euro on the part of the banks there, which has supported the euro. But on the other hand, the US economy is recovering, and typically a stronger economy is accompanied by a stronger currency. So putting the two together, I imagine the dollar index will just sort of go sideways.
What further impacts would the tapering have on US dollar and emerging market currencies? And how does the rupee stack up in comparison with other emerging market currencies?
Well, when we think back to when the word tapering was first said, and that was actually the first time it was said way back in February of last year by James Bullard, one of the Federal Reserve president for St. Louis Fed. But then when Ben Bernanke himself said it in May, that's when you started to see bond yields rise very quickly and shifts in asset allocation, including in emerging markets. My sense is the vast majority of the selling in emerging markets on the back of tapering has already happened. I think that people who are in emerging markets and did not want to be anymore because they realized the Federal Reserve was going to begin this tapering should have exited by now. As for the rupee, based on purely economic terms, in other words, purchasing power parity, real rates of return is actually very undervalued relative to its fair value. But if you look at the long-term trend, given their structural current account deficit in India, you should expect a depreciation over the longer term. But the point I would make is that we are far below what fair value is now, and if there is a BJP win in the election that's coming up in a few months, then I think that currency would appreciate closer to fair value.
So what's your outlook for gold in 2014, and what are the key cues that do you think are going to be dictating this commodity?
Well, I think we see fair value for gold at about $1,100, and clearly we're not there yet. But if you look at the shares outstanding in the major gold ETFs in the United States, they're actually pretty close to where they were before Lehman Brothers. And that was where, after Lehman Brothers, you had a massive amount of gold buying in the United States and all over the world. But people bought a lot of these investment products related to gold, and that's been the major driver of gold since 2008. So the fact that we're back to those kind of levels we were at there, or close to it, gives me some comfort that that a lot of the selling is over. But when I also look at just a long-term chart of equities versus gold, and I can take it all the way back to 1955. This is typically a ratio which goes through 10-year bull-bear cycles. So you get not just a 1 or 2 year outperformance of equities versus gold, or underperformance, but it's a multi-year trend. And we're only now 2 years into outperformance of equities over gold. Just looking back at that chart, I struggle to believe that gold is going to start outperforming equities now.
Mark, appreciate your time, and good to have you back on 18 Hours.